A few years ago, I believed financial stability would arrive when I earned more. Then my income increased, and somehow my money became harder to manage. There were more subscriptions, more accounts, more upgrades, and more decisions. I was earning better, but sleeping worse. One Sunday evening, I opened 5 banking apps, 2 budgeting spreadsheets, and a credit card statement I had been avoiding. Every number was available, yet I could not answer one simple question. If my salary stopped tomorrow, how long would my life remain standing? That question exposed the real problem. I did not need another clever app or a more detailed category system. I needed fewer moving parts, clearer boundaries, and rules simple enough to survive a stressful month. So this is not a list of extreme frugal habits. You do not need to count every coffee or remove every pleasure. These are 7 minimalist money rules designed to make stability the default, even when motivation disappears and life becomes untidy. And stay with the seventh rule because it solves the mistake that often returns after the first 6 begin working, allowing every pay rise to quietly rebuild the financial pressure you just escaped. The first rule is simple. Know your survival number. This is not your normal monthly spending and definitely not your ideal lifestyle. It is the minimum amount required to keep your essential life functioning for 1 month. Include housing, basic food, utilities, necessary transport, insurance, minimum debt payments, medication, and essential responsibilities. Remove restaurant meals, optional subscriptions, holidays, upgrades, and anything you could pause temporarily without creating serious harm. Imagine your normal life costs $3,000 a month, but your survival number is $2,100. That $900 difference is important. It means a crisis does not need to finance your full lifestyle. Only the stable floor beneath it. Your survival number gives every other decision a reference point. A $6,000 emergency fund is no longer an impressive but meaningless balance. It represents almost 3 months of protected essential life. Write the number somewhere easy to find and review it once a year. Prices and responsibilities change. The goal is not perfect precision. The goal is being able to see within minutes what must be protected when circumstances suddenly become difficult. Rule 2, always create a gap between what comes in and what routinely goes out. Stability lives inside that gap. If every pay rise immediately becomes a larger home, newer car, and more expensive monthly commitments, a high income can remain surprisingly fragile. The gap does not need to look dramatic at first. 5% is better than 0. 10% creates more room. The exact target depends on your income and responsibilities, but spending everything you earn leaves no space for mistakes, opportunities, or future you. Do not confuse a temporary spending cut with a permanent gap. Skipping restaurants for 1 month can help, but stability comes from a structure you can repeat. Housing you can afford, transport that does not dominate your income, and subscriptions you genuinely use. When money arrives, move part of it out of the spending path immediately. Saving whatever remains at the end of the month usually means saving nothing because available money has a remarkable ability to find a job. Rule 3. Keep fixed costs boring. People usually focus on small purchases because they are visible and frequent. But the commitments that decide whether your life feels stable are often signed once and then quietly charged for years. Housing, vehicles, debt payments, childcare, insurance, and contracted services form the heavy part of your financial ship. When those costs are too large, canceling coffee cannot restore the balance. Before accepting a new recurring cost, ask a minimalist question. Would I still want this payment if my income fell by 20%? You are not predicting disaster. You are checking whether the commitment leaves room for an imperfect future. This does not mean always choosing the cheapest option. A safe home, reliable childcare, or useful vehicle may deserve substantial spending. Minimalism is not deprivation. It is refusing to let low-value commitments crowd out what genuinely protects or improves your life. Rule 4. Build one real emergency fund before creating 10 exciting goals. It is difficult to invest confidently, travel peacefully, or plan a major purchase when one broken appliance can send everything back onto a credit card. Start with a small first barrier, perhaps $1,000 or another amount capable of absorbing common disruptions where you live. Then work towards several months of essential expenses, using your survival number rather than your full lifestyle cost. The appropriate final buffer varies. Stable dual-income households may need less than freelancers, single-income families, or people with medical responsibilities. The rule is not that everyone needs the same number. The rule is that foreseeable vulnerability deserves cash protection. Keep the fund accessible, separate from daily spending, and uninteresting. An emergency fund is not supposed to deliver an exciting return. Its job is to be present on the worst Tuesday of the year. But define an emergency before one happens. Income loss, urgent health needs, essential repairs, or unavoidable family crises may qualify. A discounted holiday, annual celebration, or predictable insurance renewal usually does not. Rule 5. Make important money movements automatic. Stability should not depend on remembering 12 perfect decisions every payday. Automate essential bills, emergency savings, debt overpayments, and long-term investing as soon after income arrives as practical. Automation is not a substitute for awareness. It is a guardrail against distraction. You still review the route, but you no longer need to steer around the same avoidable obstacle every week. A useful order is essentials, minimum obligations, emergency savings, expensive debt, long-term investing, and then flexible spending. Your personal order may differ, but money with important work should move before money with no assignment. If your income changes each month, automate percentages or create a holding account. When income arrives, divide it according to the same priorities. A variable income requires a stronger sequence, not a completely new financial personality every month. Rule 6. Treat high-interest consumer debt as an emergency, not a normal lifestyle tool. When interest grows faster than your savings, yesterday's purchase keeps charging rent inside tomorrow's income. List each balance, interest rate, and minimum payment. Keep a small emergency buffer so every surprise does not create new debt. Then direct extra money toward the most expensive balance, or the smallest balance if quick wins will keep you consistent. The mathematically fastest method is useless if you abandon it. Choose a clear method, stop adding new balances, and make the payment automatic. Minimalist finance prefers one imperfect plan completed over 5 optimized plans, repeatedly restarted. Credit cards can be convenient when paid in full and controlled carefully. But if they encourage spending beyond available cash, simplicity may mean lowering limits, removing stored card details, or temporarily using a debit card instead. The purpose is not to feel ashamed of debt. Shame consumes attention without reducing a balance. The purpose is to stop an expensive past decision from owning an increasing share of your future. Once expensive debt is controlled and your emergency foundation exists, invest simply and consistently. You do not need to predict the next winning company or check markets every morning to participate in long-term growth. For many people, diversified, low-cost funds held for long periods can provide a simpler approach than frequent trading, although investments can fall and the appropriate account, tax treatment, and risk level depend on your country and circumstances. The minimalist rule is not to buy a specific product. It is to understand what you own, keep fees and complexity visible, diversify appropriately, and contribute consistently without treating hypothetical returns as guaranteed. A boring plan has an underrated advantage. You are more likely to keep it during noisy markets. Complexity often feels intelligent in calm times and becomes frightening precisely when patience matters most. Now we reach Rule 7. Increase your lifestyle more slowly than your income. This is the rule that preserves everything else. Without it, higher earnings simply purchase a more expensive version of the same anxiety. When you receive a raise, decide its destination before the first larger payment arrives. You might direct half toward investing or a goal, use part to improve life now, and leave the remainder as additional margin. The percentages are flexible. The sequence is not. Choose before the new income becomes ordinary, because expenses expand quickly around money that appears permanently available. Use a waiting period for new recurring commitments. A larger home or finance car deserves more than an excited weekend. Calculate the annual cost, include insurance and maintenance, and imagine paying it during an ordinary difficult year. This rule does not forbid enjoying success. It protects success from immediately becoming obligation. Spend some of the raise on something meaningful. Celebrate. Then allow part of it to make your future quieter. Once a month, complete a 10-minute reset. Check that bills are covered, automatic transfers happened, card balances are controlled, and no unused subscription or recurring charge has quietly entered the system. Once a year, perform a deeper review. Update your survival number, fixed costs, emergency target, debts, investing rate, and major goals. Remove accounts and categories that add work without improving a decision. If these rules feel like too much change at once, build a minimum viable system. Use one account for essential bills, one for daily spending, and one separate reserve. More accounts are useful only when they make an important boundary clearer. On payday, cover the survival number first, then fund the emergency reserve or expensive debt, make the planned investment contribution, and leave the agreed amount for daily life. The system should reveal what is safe to spend without asking you to solve the entire month again. Consider what happens when the washing machine fails. Without a gap or reserve, the repair competes with rent and may become credit card debt. With even a partial buffer, the same problem remains annoying, but loses its power to destabilize several future months. Or imagine income falls temporarily. A low survival number, controlled fixed costs, and emergency cash give you several ways to respond. You can reduce optional spending, pause a goal, or search for better work without every decision being forced by tomorrow morning. This is why the rules work together. A reserve cannot protect a lifestyle whose fixed costs consume everything. Automation cannot help if it automates unaffordable commitments. Investing cannot create stability while high-interest debt is accelerating in the opposite direction. Do not turn the 7 rules into 7 new reasons to judge yourself. Financial circumstances are shaped by income, health, family, housing, and luck as well as behavior. Use the rules to identify the next controllable move, not to explain every difficulty as a personal failure. The minimalist test is always the same. Does this financial tool, account, purchase, or rule make an important decision clearer? If it adds maintenance without improving action, remove it. Simplicity is not an aesthetic. It is preserved attention for the moments that genuinely matter. Remember that Sunday evening with 5 apps and no answer? The solution was not seeing more numbers. It was knowing which numbers mattered. The survival floor, the gap, fixed commitments, emergency months, expensive debt, and the rate at which future freedom was growing. Financial stability does not mean nothing bad happens. It means fewer problems can become immediate catastrophes. The system absorbs some impact, creates time to think, and prevents one difficult month from rewriting the next 5 years. 7 rules. Know your survival number. Protect the gap. Keep fixed costs boring. Build one real emergency fund. Automate important movements. Eliminate expensive consumer debt. And let your lifestyle grow more slowly than your income. You do not have to implement everything tonight. Calculate the survival number, then automate one small gap on your next payday. Stability is rarely one brilliant decision. It is what remains when a few simple decisions keep working after motivation has gone home. If you want to understand not only how money works, but how it shapes the decisions we make, subscribe. This is Sebastian Makes Money.